Hello everyone, and welcome to our lecture on the Relative Strength Index, or RSI, a cornerstone of technical analysis. Developed by J. Wells Wilder in 1978, the RSI is a momentum oscillator that measures the speed and magnitude of price movements. Its primary purpose is to identify potential overbought or oversold conditions in a market, helping traders anticipate reversals. The RSI oscillates between 0 and 100, calculated based on the average price gains and losses over a chosen period, typically 14 days. This normalized value reflects momentum strength, with values near 70 indicating an overbought market, and values near 30 indicating an oversold market. Traders use these levels to detect changes in momentum and anticipate potential reversals. When RSI goes above 70, the asset may be overbought and due for a correction, signaling a potential pullback. Conversely, an RSI below 30 suggests the asset is oversold and poised for a rebound, presenting a potential buying opportunity. A critical concept is RSI divergence, where price makes new highs but RSI fails to do so, signaling weakening bullish momentum. Similarly, bullish divergence occurs when price makes lower lows, but RSI forms higher lows, indicating a potential bullish reversal. The 50-level centerline crossover is also significant. RSI crossing above 50 indicates bullish momentum, while a cross below 50 suggests bearish momentum. RSI works best when combined with trend analysis and support or resistance identification rather than in isolation. Let's look at an example using a S&P 500 ETF or SPY with its 14-day RSI. The top panel shows SPY daily closing prices, displaying an overall upward trend with typical volatility. The lower panel displays the corresponding 14-day RSI values, oscillating between approximately 20 and 80. Notice how the RSI line interacts with the 70 and 30 thresholds, indicating overbought and oversold conditions. Traders often look for RSI values above 70 as a signal to take profits or prepare for a pullback, while RSI below 30 is seen as a potential buying opportunity. RSI divergence, both bullish and bearish, provides strong signals for weakening momentum or potential reversals. Additionally, trend lines drawn on RSI can often break before price trend lines, offering early signals when used with moving averages or MACD. The power of RSI partly stems from its popularity. Millions of traders monitor these levels, creating a self-fulfilling prophecy. When RSI approaches 70, traders expect selling pressure, and when it nears 30, buyers step in, turning expectations into reality. From a behavioral perspective, RSI captures crowd sentiment, visualizing market emotion in a quantifiable form. Among its strengths, RSI is simple, widely recognized, effective for identifying short-term extremes and divergences, and works well in range-bound markets. However, its weaknesses include producing false signals during strong trends, requiring contextual confirmation with other tools, and its lagging nature. In conclusion, the Relative Strength Index is a powerful yet supplementary tool for momentum trading. Always integrate it with other indicators and trend analysis to avoid pitfalls and enhance your trading decisions. Thank you for joining this lecture on RSI. We hope this has provided valuable insights for your financial analysis journey.